So, every now and again, people talk about investing in the market, and that's good. But then, the market goes up, the market goes down. Now, when the market goes down, you're going to want to protect yourself. And one way to do that is with defensive stocks, right? So let's kind of get into like what they are, understanding them, advantages, disadvantages, everything that we need to talk about to give you a good understanding of, a good grasp of the situation with what we're talking about here. So let's start off with what are they? Okay, a defensive stock it's just going to be a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market. There is a constant demand for their products, so defensive stocks tend to be more stable during the various phases of the business cycle. Now, defensive stocks should not be confused with defense stocks, right? Defense stocks are, companies that manufacture weapons, ammunition, stuff like that. So let's get into understanding them. So, investors seek to protect their portfolios during a weakening economy or just like periods of high volatility. And it may they're going to increase their exposure to defensive stocks. Now, well-established companies, like think Procter and Gamble, think Coca-Cola, Philip Morris International, Johnson and Johnson. These are all considered defensive stocks. In addition to strong cash flows, these companies have stable operations with the ability to weather weakening economic conditions. So they also pay dividends, which I really like. I'm a real big dividend investor, which, they can have the effect of cushioning a stock's price during a market decline, right? Those dividends help kind of, it's not so bad money coming in. Defensive stocks are also less likely to face bankruptcy because of their relative strength during some of these downturns. In difficult times, or if things are just getting kind of shaky or uncertain, why would anyone even want to own a stock, right? Why not just go for the safety of, I don't know, let's say a treasury bill, right? That essentially has a risk free rate of return. Well, the answer is simply that fear and greed often drive the markets. Defensive stocks, they accommodate greed by offering a higher dividend yield that can be made in low interest rate environments. They also alleviate fear because they're not as risky as regular stocks, and it usually takes a significant, just mind-boggling screw up to derail their business model. Investors also need to be aware that most investment managers have no choice but to own stocks. If they think times are going to be harder than usual, they're probably going to migrate towards defensive stocks. Defensive stocks tend to perform better than the broader market during recessions. However, during an expansion phase, they tend to perform below the market. Now, this is going to be attributable to their low beta or market related risk. Defensive stocks typically have betas of less than 1. So to illustrate beta, let's consider this. You got a stock that has a beta of 0.5. Now, if the market drops 2% in a week, then you could expect the stock to lose about 1%. On the other hand, if it goes up 2% in the market for a week, that's going to lead to an expected increase of also just 1%, right? So that 0.5, a bunch of things are going to take a hard hit, but the defensive stock's not going to be that bad. But same thing when it goes up, it's not going to go up that much either. So let's talk about some of the advantages we have with these. So defensive stocks offer the substantial benefit of similar long-term gains with lower risk than other stocks. Defensive stocks as a group have a higher Sharpe ratio than the stock market as a whole. That's a strong argument that defensive stocks are objectively better investments than other stocks. Warren Buffett also became one of the greatest investors of all time, in part by focusing on defensive stocks. It is not necessary to take excessive risks to beat the market. In fact, limiting losses with defensive stocks may be more effective. And of course, if there's advantages, you know what that means: disadvantages. So on the downside, the low volatility of defensive stocks often leads to smaller gains during bull markets and a cycle of mistiming the market. Unfortunately, many investors abandon defensive stocks out of frustration with underperformance late in a bull market. And that's really when you need them most. And then after a downturn in the market, investors sometimes rush into defensive stocks, even though it's too late. Now, these failed attempts at market timing using defensive stocks can significantly lower the rate of return for you, right? So you got to be careful. Don't time the market. Let's talk about some examples. And I'm sure you're like, well, I gave some earlier. Let's talk about some other ones. Because defensive stocks are also known as non cyclical stocks because they're not highly correlated with a business cycle. So let's talk about four different types. Let's start with utilities, right? Water, gas, and electric utilities are going to be examples of defensive stocks because people need them during all phases of the business cycle. Utility companies also get another benefit from a slower economic environment because interest rates tend to be lower. Now we have consumer staples, right? Companies that produce or distribute consumer staples, which are goods people tend to buy out of necessity, regardless of economic conditions, are generally thought to be defensive. Think food, beverages, hygiene products, certain household items. These companies, generate steady cash flow and predictable earnings during strong and weak economies. Their stocks tend to outperform non defensive or consumer cyclical stocks that sell discretionary products during weak economies while underperforming them in strong economies. And of course, healthcare stocks. How could we forget that? Shares of major pharmaceutical companies and medical device makers have historically been considered defensive stocks. After all, there's always going to be sick people in need of care. However, increased competition from new drugs and uncertainties surrounding regulations mean that they aren't as defensive as they once were. Then, of course, we've got apartment REITs. Now, apartment REITs, or real estate investment trusts, are also deemed defensive, as people always need shelter. When looking for defensive plays, steer clear of REITs that focus on ultra high-end apartments. Also, avoid office building REITs or industrial park REITs, which could see defaults on leases rise when business starts to slow. So, what do we learn from all this? What are the key takeaways? Okay, well, number one, a defensive stock is a stock that provides consistent dividends and stable earnings regardless of the state of the overall market. Number two, well-established companies such as Procter and Gamble, Johnson and Johnson, and Coca-Cola, these are considered defensive stocks. Okay, number three, defensive stocks offer the substantial benefit of similar long-term gains with lower risk than other stocks. And of course, lastly, number four, on the downside, the low volatility of defense stocks often leads to smaller gains during those bull markets and a cycle of mistiming the market. So now that we know what defensive stocks are, you can go look into, I gave you a couple examples, but you can go look into them more to help protect your portfolio during when a market goes down, right? I hope you guys really enjoyed this video. If you did, go ahead, smash that like button for me. If you're not subscribed to the channel, go ahead, subscribe to the channel. I'd really appreciate it. But until I see you guys in the next video, y'all be safe.